Thank you for joining me. I'm Scott Ryan. Well, I'm about to make some statements and commenting on the Facebook situation and Morgan Stanley and other participants in this IPO that are going to be perceived by some as controversial. But I want to say in the outset, the answer to the problems I'm highlighting is not government regulation, because these elected imbeciles and their appointees, their bureaucrat appointees, and the usurping agencies which they represent are far more dangerous to our liberties, far more dangerous to America than even the worst scoundrel on Wall Street. But one thing I want to say is there's a lot of talk about the IPO. I've had some debates with conservatives who are saying that it's not fair to criticize the company, Facebook or Morgan Stanley, because the owners and investors of Facebook risk their capital and they're entitled to get whatever they could in the IPO. I think that is a misunderstanding of the purpose of the investment banking function. I do not believe that I believe that the owners have a right to get whatever they can for their company within reason. I mean, it's a misunderstanding to say that these investment bankers, their function is to get as much as they can by hyping a stock as much as they can and find the biggest sucker out there who's willing to pay it and exploit that. That is not the job of an investment banker. The investment banker represents two sides. They're representing the company that they're taking public, and their job should be to get a fair and reasonable price for the investors on the other side of their business who trust their name and their analysis and their investment acumen. They have a fiduciary responsibility to both sides. I don't believe that investment banking companies should only be allowed to do investment banking and brokerages should only be allowed to do brokerage or financial advice. I just believe that what we are seeing is representative of the fact that our founding fathers said over and over again, such as John Adams, who said that this form of government, this Constitution, was made only for a moral and religious people. He said it is wholly inadequate to the government of any other. And that's important because capitalism is merely a term for freedom. It is the economic corollary of our Constitution, of the basic ideals expatiated in our founding documents. We see people in the media and liberals trying to complicate it and demonize it. All it is freedom. And it is true that when people as a whole when they become immoral, when they become so selfish that they use their freedoms to steal and encroach upon those of others, it's like a gun. A gun is neither good nor bad. Freedom. It depends on the person who's using it. And when you have a society of people who have been taught that they are animals, that there is no meaning, that this is all an accident, and there is no system of rewards and punishment, why should there be any compunction? Why shouldn't you take what you can get now? And that is what we are seeing. It's pervasive, not just on Wall Street, but in government. These people, these liars, these frauds who hold themselves out to be for the people. John Edwards is the quintessential example. He is the defining example of what we have in government. What he did is probably diminutive in comparison to what people like Charles Rangel and Barney Frank and Chris Dodd, those guys who ran out because they knew that they are treasonous scoundrels. What Edwards got caught for is diminutive compared to what the rest of them do. And we are seeing it all fall apart. If we had a moral people, if we had ethical people at Morgan Stanley, then we would have seen them do due diligence on this company and realize that this company, it may be worth the $100 billion market cap that they were purporting, But they would understand that that is extremely subjective. There is so much goodwill in that stock. I mean, if you were looking, they were projecting earnings of about 40 cents a share over the next year. They were assigning this in the primary market to their firm, to their firm's clients, with a multiple of 75 times earnings. That is a lot of goodwill. I mean, if you were to look at this company and say, all right, as a private company, any private company, if you were a business person buying a company as a rational investor, a private market is a rational market, would you buy a company that's earning for a price of 75 times what they're supposed to earn next year if those earnings were going to stay flat? It would take you, in that case, 75 years to make a profit equal to what you paid for that company. How are you going to pay yourself? So you have to, in order for that to make sense, you have to have some kind of demonstrable track record that can really make a compelling case that that company is going to grow at a double digit, substantially double digit, like maybe 75% a year for the next 5 years for that to make any business sense. Now, the problem is you can't really make a compelling argument that that would be the case. It may very well. Facebook may be worth $500 billion a few years from now. We don't know that. There's too much unknown here to come out in the primary market with that kind of a figure. Now, if they would have come out with a figure of maybe $20 a share, that, I mean, even then, like today, it closed around $26 per share, the 31st of May, and it's over 50 times earnings. That's even generous. I mean, would you buy a company that would take you 50 years? Would you buy it for a price that would take you 50 years to pay off before you paid yourself? Again, if earnings stayed flat. I still think it's generously valued. It's still risky. If people want to, if they want to take it public at a reasonable price, at say $15 a share, and then the secondary market wants to bid it up to $100 a share, if they're willing to pay for it, that's another thing. That's just the stupidity of crowds. But in this case, this was either stupidity by Morgan Stanley, or it was sheer ineptitude. And let me give you my thesis as to why I think this way about Facebook. From a business standpoint, I hear a lot of what has taken place hyping this stock has been the 900 users of Facebook. I mean, that's impressive. That's an impressive number. But that doesn't translate to impressive earnings, as we can see the next year's projected earnings of 40 cents a share. I mean, large numbers don't mean anything if you can't monetize them. And the question is, will they be able to? I mean, think about the old Bell telephone before the breakup. I mean, they had everybody in the country participating. Pretty impressive numbers if you look at the phone books. That doesn't mean that they were worth 100 times earnings. Now, one of the things that really got the bubble going, that really excited a lot of people, is this, what I believe to be a fallacious comparison to Google. We've all seen what Google has done since the IPO. It's one of the few internet companies out there that has actually a long-term record of great success from the IPO price. If you bought in that IPO at any price, you're doing quite well right now. But there's a huge difference between what Google has going for it and what Google does in Facebook. I have tested both on 2 different business campaigns. Each one I've used on Google and I've used on Facebook. And I have found Google to be far superior to Facebook in every way. I got far more results. And the reason is, when people are going and using Google's search engine, They are always looking for something. It may or may not be that they're looking to buy something, but they have a need. They're looking for something. And often they are looking to buy something. And Facebook allows companies, like in my case, to target people that are looking for something in whatever area from which they're looking at it. Or you can, if you're international or national, it was very impressive. And their metrics were incredible. You could tweak, their system, you go in there and you can tweak your target market and change your keywords. And it was very effective, the measurements and the whole process. My results were far, it blew away the money that I spent on cable television advertising by far. The amount of money that I spent in cable advertising was astronomical compared to what I got through Google. Google was a fraction if you look at the cost, the return on investment. But when people are looking at Facebook, when I'm on Facebook, I'm not looking for something. I'm looking to see what my friends and family are up to. I'm not going to click on anything other than their interactions. I've seen many ads. I have yet to click on one. When people are out there on Facebook, they're looking to see what Aunt Martha is doing, or their nephew or their niece or their child or their grandchildren or their friends. That's what that's all about. There's a huge difference. So it's basically, Facebook has some eyeballs. They have a lot of eyeballs that'll see these ads, but we're not looking for anything. I don't see the kind of growth potential. I would equate Facebook to a magazine, a very successful magazine that has 900 million subscribers. They're there to look at the content, which is not the advertising. And I believe that it should trade at a multiple comparable to perhaps traditional media. Google, on the other hand, has made all the right moves. When they were hot, their earnings were growing. They used their stock as capital, and they went out and acquired companies, still acquiring companies. They've integrated them, and they've made them work. They're firing on all cylinders. They have proven the naysayers wrong. What they're doing with the Android, huge success. With these acquisitions, they've defied the odds. Most companies that go around acquiring other companies with their stock usually fail and end up spinning them all off, like AOL did, which was a case that I had warned about back when AOL was the most widely held stock in America before that bubble burst. You can see that at tableofwisdom.com, where I have it all time stamped and sourced. Google, nevertheless, has been doing everything right. They've acquired the companies, they've integrated it, they made it work. They even have a car that drives itself and that works, and that, from what I've read about it, it could become worth more than anything else in the company in the future. Very few people even know or talk about that. But this company, there's no comparison between that and Facebook. When I look at great companies like eBay, not that they're the same, they're a very different market, but like eBay at 50 billion or less than 50 billion, which is doing phenomenally, and owns PayPal, which in itself is probably worth more than 50 billion over the next few years. How in the world could they come public with Facebook unproven, with such a huge multiple to earnings, with no real demonstrable reasoning for double-digit earnings growth? How could they come out with it responsibly, a firm like Morgan Stanley, at $100 billion on the IPO? The roadshow itself was evidence. I said in my May 4th column before that IPO, when I advised at tableofwisdom.com to short Facebook on the IPO, as I had written in that piece, there was no need for a roadshow for Facebook. That I said before that IPO, this is proof that they are looking to hype this stock. Everybody in the world knew Facebook was coming public. So the purpose of a roadshow is a hype show. They would have gotten, without that roadshow, what Facebook, a reasonable price would be. They weren't interested in reasonable. They were interested in exploiting, fermenting a bubble. I mean, you can make a bubble out of anything. If stocks are worth, justifiably, anything that the public is willing to pay at the IPO, if you think that that is the responsible capitalist representation, then you're a fool. Because you could do that to any company. These brokerage firms and the analysts, they are a syndicate. They can hype anything. Right now, the U.S. Treasury is the next Facebook. When you look at the fact that this bankrupt country that can't even pay the interest on the debt is getting less than 2% on a 10-year Treasury, that is the biggest bubble. That is the next Facebook. Does that make it right? No. There's a lot of chicanery behind the scenes. Thanks for joining me. I'm Scott Ryan.